The moment you sign a loan agreement, something strange happens. Not in the room, not on the paper, but inside the financial system. Money appears. Not transferred, not moved, created. And almost nobody tells you this part. We're taught a simple story. You save money, the bank holds it, then the bank lends that saved money to someone else. Nice, clean, comforting. It's also wrong, because when you take a loan, the bank is not giving you someone else's money. It's creating new money out of nothing, legally. And once you see how this actually works, it changes how you see debt, banks, inflation, and even your own paycheck. This matters now because global debt is higher than it has ever been. Household debt, corporate debt, government debt. We live inside a system powered almost entirely by borrowing, and most people borrowing inside it don't know who's really holding the pen. So let's slow this down. No jargon, no textbooks, just the mechanism. Imagine you walk into a bank and ask for a loan, maybe for a house, maybe for a business, maybe just to survive a bad month. The bank does not go to a vault and count cash. It does not check if someone else deposited enough money today. Instead, it checks two things. Can you repay? And is it allowed to create this loan under regulation? If the answer is yes, the bank opens a computer and types a number. On one side of its balance sheet, it writes, loan asset, $100,000. On the other side, it writes, deposit liability, $100,000. That deposit is credited to your account. You see the money. You can spend it, transfer it, buy real things with it. As far as you're concerned, that money is completely real, because it is. But here's the uncomfortable part. Before that moment, that money did not exist. No saver lost it. No taxpayer funded it. No central bank sent it. It was created the instant the loan was approved. The bank didn't lend money, it manufactured money. And the only thing backing it is your promise to pay it back with interest. This is not a conspiracy theory. This is standard banking. Central banks admit it. Textbooks quietly confirm it. Most people just never hear it explained this plainly. Now, here's where the story gets interesting. When you repay the loan, something else strange happens. The money you pay back does not go to another borrower. It does not get recycled. It disappears. The principal is destroyed. It's deleted from the system. The interest, however, stays. That interest becomes bank income, salaries, bonuses, dividends. So money is born as debt, and it dies when debt is repaid, except for the interest, which means system-wide, there is always more debt than money. Pause on that for a second. If every dollar is created as a loan, and every loan requires repayment plus interest, where does the extra money come from? It can only come from more loans. This is the hidden engine of the modern economy. Constant expansion of credit, not because people are greedy, not because banks are evil, but because mathematically the system requires it. If lending slows down, money supply tightens. Businesses struggle, people lose jobs, recessions appear. If lending speeds up too fast, money floods the system. Prices rise, assets inflate, inequality grows. This is why central banks obsess over credit conditions. They're not really managing money, they're managing borrowing. Now, you might be thinking, wait, what about central banks? Don't they print money? Yes, but not the way you think. Physical cash is a tiny fraction of the money supply.
Coins and notes are the surface layer. Over 90% of money in modern economies is digital bank money, created by commercial banks when they issue loans. Central banks influence this process indirectly. They set interest rates, they set reserve requirements, they act as lenders of last resort, but they do not decide every dollar that appears. Commercial banks do, loan by loan, customer by customer. This is where power quietly sits, not in the act of printing, but in the act of approving. Who gets access to credit determines who gets access to newly created money. That's why housing markets explode. That's why asset owners benefit first. That's why wage earners feel last. When banks lend mostly for real estate and financial assets, money flows upward. When they lend for productive businesses, economies grow more evenly. Same mechanism, different outcomes. Now let's address the myth that never dies. Banks can only lend out what they have. This sounds logical. It feels responsible. It's also outdated.
Banks are constrained not by deposits, but by capital rules and profitability. If they can find borrowers who can repay, and if regulations allow the loan, the money will be created. Deposits often come after loans, not before. In fact, when banks need reserves, they can borrow them from other banks or from the central bank. So deposits don't fund loans. Loans create deposits. This flips the story most of us were taught. And once you flip it, you start noticing things, like why debt-based growth feels fragile, why financial crises keep repeating, why bailouts always seem urgent. Because when loans collapse, money disappears. Defaults don't just hurt lenders, they shrink the money supply. That's why governments panic during financial crashes, not because banks are special, but because money itself is at risk. So they step in, they guarantee, they inject liquidity, not to save banks, but to stop money from vanishing too fast. Now zoom out even further. Think about what this means for you. Your mortgage didn't come from someone else's savings. Your student loan didn't drain a vault. Your credit card limit is not a pool of stored cash. It's access to newly created money, priced by interest. And that interest is the cost of participating in the system. You're not just borrowing money, you're renting it from the future. This is why personal debt feels so heavy, because it's tied to time. You're committing future labor to justify money created today. And when millions of people do this at once, the future becomes crowded with obligations.
That's when growth slows. That's when stress rises. That's when people feel like they're running faster but staying in place. Now let's talk about the irony. Banks are often described as intermediaries, middlemen. But in reality, they are more like publishers. They issue money. You write the story that gives it value. If you succeed, the system expands. If you fail, the system contracts. And yet, most people blame themselves entirely. I should have worked harder. I shouldn't have borrowed. Sometimes that's true. Often it's structural. Because when money itself is created through debt, stability depends on everyone continuing to borrow and repay smoothly, which rarely happens forever. This is why economic cycles are not accidents. They're features. Expansion, contraction, repeat. Now here's the part most explainer videos stop short of. Who actually benefits the most from this system? Not borrowers, they carry the risk. Not savers, their money slowly loses value. The biggest winners are those closest to money creation: banks, asset owners, institutions with easy credit access. This doesn't mean the system is evil. It means it's designed around leverage, and leverage amplifies advantages. So when people say money is fake, they're half right. Money is a social agreement, but debt is very real, and it's the backbone of how modern money comes into existence. Which brings us to the uncomfortable question. If money is created by private banks as interest-bearing debt, who should control that power? Should it be profit-driven institutions? Should it be governments? Should it be redesigned entirely? There are no easy answers. Every alternative has trade-offs. Every reform shifts power somewhere else. But one thing is clear. Until you understand who creates money when you take a loan, you're living inside a system you don't fully see. And systems you don't see are the ones that control you the most. So next time you hear about debt ceilings, interest rate hikes, or credit tightening, ask a quieter question. Not how much money is there, but who is allowed to create it today? Because the future of the economy is written one loan at a time, and most of us never get to hold the pen.